Hi everyone, welcome to this Xoogler community meetup around personal finance. We're now doing this as a weekly series due to, hi Fabio, due to demand and interest. I'm so glad to have Xoogler to actually conduct and moderate this interview with Ali. I've known Ali for now probably 3-4 years. He's been an amazing founder, friend, one of our friends from Andreessen Horowitz, and he actually introduced us, and we've been partnering up on different activities and programs, and today is the launch of one of his new products, so I'm sure he's going to talk more about it. But thank you again for joining this series of events and give us feedback what else you'd like to hear from personal finance. And over to you, Xoogler.
Thank you, and welcome everybody. Thank you for joining us this evening. Very excited to talk about personal finance with Ali, particularly because this has been a core passion of mine. Like, here's a fun story. When I first landed in US in 2011, as an immigrant, even though you have some savings in your home country, you basically come with nothing. And I checked into this hotel that Google put me up on, and I turned on TV, and the first thing I see on TV was this lady called Susie Orman, and she's talking about investing and saving and yelling at you, and like that had a profound impact on me because no one really, I haven't seen any kind of TV like that. And I started looking into all sorts of things from 401k to public equities to alternate investments to venture investments within the next couple of years, and have been very passionate about like investing. I think outside of your salaries, this is the greatest wealth building tool that we all have. And I'm very happy to have Ali with us, who has been a phenomenal supporter of the Xoogler community, of everything that we have done, and of course, incredible founder himself with multiple exits, and now founder of Sandhill Markets. So without further ado, Ali, I'd love to leverage this opportunity to learn about your journey as a founder, talk to us about personal finance, and explore Sandhill Market as how you started offering secondaries, pre-IPO startups and companies to make that accessible to everyone. But before we get there, a standard disclaimer that none of this is financial advice. We are not financial advisors. We're just trying to collectively share what we know about investing through our own personal experiences. And but enough said. Let's start with Ali. Like, Ali, why don't you start with your journey as a founder first?
Thank you for having me. Love the Xoogler community. You guys make it really easy to support you because you built such an awesome community. Xoogler and Chris, I think you're stewards of an amazing group of people. So you put this together. So excited to be here. My quick background: I grew up outside the U.S. Till high school, came here for college, went to Williams, dropped out, moved to California, did my first startup. Went through many pivots. We were trying to compete with sort of Facebook in the early days. Network effect. Learned what a network effect is the hard way, and ended up pivoting to something. It was a company called Bean Labs, had an exit. Then did a company called Streamlabs that also started its life as something else. Went through like 30 different pivots. We started as a luxury car sort of sports car peer-to-peer rental service, like Turo, get around in that space. And then pivoted many times over and turned into Streamlabs. Sold it to Logitech about 4 years ago. And that's when I really got into angel investing earnestly. I think before then I had done maybe like 6 or 7 or 8 deals. But really sort of got into it when I had more time. This is sort of angel investing is a combination of time and money. You need both. Did that. I've been doing that since sort of 2018, 2019, and recently a new startup. We're about 2 years in, and it takes about 5 years to really get to product market fit. So we're about 2 years into that journey. So we'll see how it goes. But so far things are looking good. This new one is called Sandhill. A16Z and a bunch of other great folks started its life as a demo day product called Stonks, and then evolved into Sandhill, which is sort of a Robinhood for private markets.
Very cool. You'll talk more about Sandhill and your learning from Stones. Tell us, take us back and tell us about what were some of the first few investments that you made, or maybe before you made the investment, you need to save money or earn money to get there. Like, what was that journey like, and what was your first investment?
I'm really bad at investing. I'm not like a public markets expert or a personal finance expert. I think there's a lot of people out there who are much better at it. They'll tell you how to use 401ks efficiently and all of these tax strategies efficiently and how to sort of set up a Roth or like a backdoor mega Roth, whatever. I grew up with sort of that basic immigrant mindset of like save money. Really, liquidity wise, it was just my exits where I made some money and sort of got into investing. I think I've been more lucky than smart. But to be lucky, I think you do have to have, chips on the table, right, for luck to happen. So a couple of stories. I think early stage, I've done about 75 deals now.
Wow.
And late stage, perhaps my favorite one is Airbnb. So I invested into Airbnb pre-IPO. And that's where sort of a little bit of the Sandhill thing comes from, is it wasn't the highest multiple return, but I put a significant amount of money into it, like 7 figures, and it ended up 3xing in 2 years. So from like a total return perspective, that was pretty significant as a single investment, as a late stage, because the time to liquidity is much shorter on these late stage deals, right? As long as you don't pick it out. But yeah, the early stage stuff, I think still, they say it takes about 10 years. I'm like still 4 years in on the early stage. There's some winners, right? So there's AngelList, there's Pixart, there's Jar, which we talked about. There's US Mobile, there's a few that, Bazaar, that look like they're going to be big companies someday. They're really showing promising signs, but we're really just gonna have to wait a few more years to see.
Got it. Before we get into Sandhill, can you talk about what is the venture secondary market? What does it mean to participate in that? What opportunities do you see? Airbnb was a great example that you made, that getting into pre-IPO companies can be very powerful. But talk us through the mechanics of how it gets structured and how you're able to get access to those things.
Yeah, so like fundamentally, private market investing, I guess take a step back. So the reason to think about startups or private markets in the first place is companies are staying private longer and longer. Right, so a lot of the value creation that used to happen in public markets is now happening in private. So a good example is AOL went public in 1992, right? One of the first internet IPOs. Can you guess what they raised?
20 million.
Very close. Will you guess the valuation?
200 million.
So they raised 10 million at 70 post, right? That was their IPO valuation.
Wow.
They were in the public markets raising 10 at 7. That's like a seed round, right? Or like a A round. And these days, even Google, right? Google went public. You guys are Xooglers. Google went public 4 years after founding. That doesn't happen anymore, right? Airbnb, Dropbox, they're all been private like 12 years, 14 years. SpaceX now, which is a super hot late stage company, has been private for 23 years, 22 years. Stripe, 10 plus years, right? No exit, no like plans inside. So on average, they're taking about 15 years, right? And Stripe is valued about 50 billion. So like that 0 to 50 journey has happened in private markets.
And why is that, Ali? Why are companies not accessing public markets for liquidity?
Couple of reasons. I think regulations have made it much more expensive to be a public company, right? So Sarbanes-Oxley, Dodd-Frank, all of these things that happened in response to like the financial crisis or the dot-com bust. where regulators are trying to protect people, sort of the consequence of that is it becomes much more. So if you talk to a public company CFO, they'll typically tell you their budget of being a public company, even as a small cap or a mid cap, is about 30 million a year. Right? So if your earnings are like, if you're a smaller mid cap company and your earnings are 80 million a year, you're spending 30 in compliance. That's just like the trade-off isn't always there, right? So that's one. The other part is private markets are sort of liquidity in hedge funds, VC funds has exploded, right? So funds are now like very commonly sort of over $1 billion, right? $5 billion funds, $2 billion, $10 billion funds. So you can raise a lot of money in the private markets that just wasn't possible in 92, right? Or 94. So now you combine these two things, if you're like the Stripe CEO, okay, well, if you could raise 5 billion or 10 billion in the private markets with no cost or very little compliance, right, why would you hire 100 people, pay 30 million a year at least, deal with all of the liability and class action lawsuits and audit committees and boards that you have to put together as a public? Why would you do that if you can raise the same money for way easier and lower cost, lower compliance in the private? So that's why they're staying, right? They can't stay private forever.
Yeah.
There's some dynamics where you have to provide liquidity, which is where secondaries come in for employees. You guys have worked at Google, right? You may have not had this problem because Google's been a public company for so long, and they went public so quickly. But a lot of the folks at Stripe, at like Databricks, at all of the sort of Anthropic, OpenAI are newer examples, but they've been stuck there for a long time, right? And as an employee, like most of your net worth is tied up in the equity of like one of these companies, right? That you're working at. And you want liquidity, like you could probably wait a year, 2 years, 5 years maybe, but eventually life happens. Life doesn't wait. You're gonna get married, you have kids, you have a house, like you have to pay off your student debt. Like, how am I gonna convert my imaginary paper wealth to real money, right? If my company is not a public company. So that's the disconnect. And that's why I think, that's why like this whole private markets thing exists. Whether you invest early stage, late stage, different strategies, sort of various ways to go about it, but yeah, that's fundamentally why it matters.
Thank you. I think you gave a very good synopsis of the mega trends and why private market exists. How did you come up with the idea of Sandhill Markets and what it does?
So we were doing something else before, right? Like Stocks, and we had about 30,000 LPs on the stocks platform, accredited, who were already doing some kind of venture investing in tech. And we didn't have a product for it, but a lot of them ended up investing in late stage deals with us, right? They were just asking us, hey, can you get me into SpaceX? Can you get me into Stripe? Can you get me into Epic Games? Can you get me into Angular? Can you get me into Discord? And so we were just like, network around and call up people who were in those deals and say like, hey, is anyone willing to sell a stake? Fund or an employee or, and so good example is we were part of like Elon taking Twitter private, right? So when Elon purchased Twitter, we actually showed up to the Gigafactories in Austin and Fremont, like a big sign. It was a bunch of people, we tailgated, right? And we made some noise and, a bunch of funds called me, and like 5 funds called me. They're like, yeah, we have allocation deal, we can give you some of this. And so we got into the deal, right? And people loved it. They're like, this is way more interesting and exciting. And around the same time, interest rates started to go up, right?
Yes.
So demand for risky investing, especially early stage where you have to wait 10 years to liquidity, 10, 12, 14 years, cratered.
Yeah.
And so you see this in AngelList data as well, where it's down 80%, something like that. It's been a tough 12 months, right, for like risk appetite. So people gravitated more to late stage deals where it was sort of 2 to 4 years to liquidity rather than 10.
Yeah.
And that's where we ended up doing like 25 million into these late stage deals without a plan or a product or anything, just sort of connecting people to other people. And that was really strong signal for something that had more evergreen appetite once the ZIRP days, the zero interest rate days went away. And yeah, that's where Sandhill came from.
Brilliant. So how does Sandhill work? So you go get access to a block in these pre-IPO private companies, and then you offer it to angel investors or accredited investors. Can you walk us through that process?
Sure, it's very simple. So there are two types of when you buy a share. It can be either a primary, where you buy it directly from the company. Typically, companies are taking a fundraising round. You're a big VC fund, and so these late stage companies, you write like a $200 million check to lead a $500 million round. Right? That's what some of these late stage rounds look like. A secondary is where you purchase from somebody already on the cap table, right? It could be an employee, it could be a fund, an early stage fund. So let's say, Founders Fund or Sequoia invested in a seed round at some, at one of these hot startups. They bought in at $1 a share, and that's now worth $400 a share, right? They have two options. They can either wait for an IPO, which could be years away. I don't know. The partner has bills to pay. They kind of have to show some DPI. They kind of have to show this is real, and maybe take some chips off the table because who knows when the market might crash or what the prices might do. So they will typically say, okay, yeah, maybe we should take some chips off the table and let's sell like 40 million, 50 million of our position overall, which could be in the billions, right, with these late stage deals. And that's where secondary comes in. So secondaries are you're buying either from employees or investors, early investors who are already on the cap table who want to take a little bit of their position and de-risk, take some chips off it. So we will take a small piece of these deals, typically anywhere from sort of $250K to $5 million, right? Bite-sized chunks, put them into an SPV, and let accredited investors, QPs, sort of buy into these SPVs. Doing that, we do a bunch of things, right? So we can reduce the minimums, so you don't have to invest $250K or $1 million. We can bring the minimum, depending on the deal, down to like as little as $5,000. Because multiple people can be in an SPV, right? There's some legal limits on how many, but you can drop the minimums to 5K, which is kind of like, wow, right? Because now, like with a 5K check, people can kind of access names like Stripe and SpaceX and Antero and Epic pre-IPO. It just wasn't possible, right? Like with these blue chips, you kind of really needed a six-figure check to get into, have any hope of getting into these things. And to know the right people, six-figure check. You can get into like some other less exciting deals for like 50K, 20, but for like these blue chips, you really need your six-figure check. So a small check sizes, you focus on blue chip names. And there's over 500 unicorns. And we're really only focused on the top 20, give or take. The names that have the most demand, have built the best businesses, sort of category leading businesses that I would put my own money in. So that's sort of a personal filter I apply to this is like, what would I invest in? Mm-hmm. If I wouldn't invest in it, you don't put it on the platform. You don't think about it. Because I still do some late stage investing, right? We can talk about like some favorite picks and like my personal favorites, but it's sort of one filter I use, and we look at category winners. So typically these tend to be the top 20.
Got it. So Ali, walk us through how should we think about these investments. For example, in public equities, there's a lot of data available that I can analyze, market reports that are available. In growth equity or pre-IPO companies, the data is not quite there. Beyond the brand that these companies have built or the perception that, hey, they're doing well, there may or may not be some reporting. How do you underwrite it to justify that's a sound investment? And what do you do as Sandhill to kind of like surface that data to investors?
Good question. Honestly, that's the biggest con of investing in these pre-IPO deals as a small investor or an individual or like someone who's not writing like a $10 million, $25 million, $50 million individual check, right? Is information. So like when you invest early stage, you know the founder, right? You get financials, the plan, product, whatever. Or if you're late stage and you're like Fidelity or Sequoia Growth, you're writing a $200 million check, you get it. But as a small check writer into these big deals, you don't get any information. That's the biggest con. And even we don't have like information most of the time, right? Sometimes we do, but like we can't share it broadly or there's restrictions in NDAs. But a lot of times even we don't have direct financials from the company, right? So what we do in those cases is we'll work with third-party experts who kind of have triaged through a bunch of sources, like, within this range, this is the revenue. This is sort of the 5-year revenue. This is what analysis. So there's some folks in the space that are doing really good work, like the Generalist, Sacra, Notice, AidView, Zimbardo, even Garda and AngelList to some extent, right, and publish research and reports on individual companies, including things like share prices. There are third-party data providers now who triage, like you take an individual stock like Stripe or Databricks, and they're gonna like collect all executed transactions in that name over the last 3 months, and they'll give you like an average price and price history, right? Kind of like public markets, not as like firm, but you plus minus a couple of percent. So you're getting pricing, which is pretty good, and then you're getting third-party research reports. So there's the equivalent of like a Morningstar. For private. So we work with them to kind of put all this information together, right, and give this to you through your Sandhill account. So you log in, you get a price graph, right, a 1-year, 2-year price graph of Stripe, right, or any of these companies, and you can look at their last round information. Okay, what was their share price in their last 8 rounds, like Series A, H, F, E, whatever, and compare that to like an actual trading price. Like what are people paying for this today? What are family offices paying? What are institutions paying? You can look at, okay, Fidelity owns this, right, and they're a public entity. Where have they marked their position in Stripe, right? Okay, Fidelity's marked it at, I don't know, 22. Market is paying 24. The last round was 30. Okay, what should I have these data points, and then that helps people triage what they should pay. We don't tell them obviously what to pay. We're not in that business. We let them pick their own deals, but we do try to get that information. But it's not perfect.
No, thank you for that honesty. But they still make like really incredible investment, like Airbnb. If you put in like 100K, make 300K, like in your case, 7-figure. And what's the time to liquidity in these deals? What's the question that I'm leading to? So I get it that these startups, Databricks, which is live on your platform, I saw this morning, they have been around. I think they're on the Series K now. I think A, B, C, D, F, G, H, K.
All the alphabet soup.
They're making billions of dollars. Clearly, a very strong fundamentals company everywhere. Or you go to like conferences like Dreamforce that's happening, or any enterprise data conferences that you go to, they are the name there. They're one of the power players. But they haven't IPO'd. So should I invest in a company like Databricks? And if so, what should be my time horizon for liquidity? Because I also want liquidity. I'm happy to provide that as an investor for an early stage employee, but then what's my path to getting the money back?
Yeah, great question. I mean, typically with these things, it's like 2 to 4 years, right? So it's like, it is much shorter. So on one side, you have the public markets, which are liquid 24/7. You have, I guess, 24/7 during business days, and you have crypto, which is quite literally 24/7. And then on the other hand, you have sort of the other extreme is early stage. Late stage is somewhere in the middle, right? 4 years. One of the things we're doing, but we don't really know, right? Like Databricks could say, well, let's go another 2 years in the private markets. SpaceX has gone more than 20 years, right, as a private entity. So we don't know for sure. Instacart and Arm and Klaviyo are going public now,
yeah.
right? And the IPO window hopefully is opening up again, right? Like the 7% interest rates don't help. There's a lot of companies will delay going public because they think they get a better price in the private versus public markets. But we don't know. So one way, we're solving that is we introduced like a new auction format where you can take a block of shares. We have Databricks on live today, and you could list your position and see what everyone else is going to bid for them, right? It's a many-to-one auction. So you have one seller, you have up to 99 buyers going into an SPV, buying that set of shares. And the market then figures out like what is the right number.
Yeah.
Right? You have all the information, you have all of their last rounds, you have data on like what the market's trading at, you have data on the company, you have news articles and sort of triage information, the best you can get. But then everyone kind of figures out what they want to pick. We're going to do that for investors as well, right? So one legal issue here is you do have to hold these shares for 1 year at least before you can resell them in the secondary market.
Yeah.
Right. When you go IPO, there's typically also going to be a 6-month lockup, right?
Yeah,
so like
that's
about a 1 year, at least you're gonna have to hold for at least a year, right? Pretty standard. So say you bought Databricks today, what we want to enable, and this is coming next year, is create a marketplace where people who buy in through us, right, for the first time, can then turn around and sell their positions after a year. They don't have to wait for an IPO, right, to other investors on the platform. So the hope is that there will at least be an option of liquidity, and you don't have to just, it's not a forced buy and hold rate. So it'd be a mountain to climb to build that, right? Create enough buyers, liquidity, enough funds and market making and sort of all of these mechanics, but I think it's a fun problem to solve.
Yeah, very cool. And that sort of is the future of this like just to build up on what you're saying, pose a question as well. Right now, yes, an early stage employee or an investor wants to sell equity or part of their position, and some of us may be able to access the standard. Do you see that like more structured product options, derivatives, and exotic products are going to get created on the same model where you provide liquidity within this market, which means that what's the need to, is it a way to like hack the IPO process, and will regulators be like looking at, they can't look at it with a friendly eye because you're skirting your potential liquidity and coming under the purview of extreme regulation, albeit, but under regulatory oversight completely. Databricks is a good example of that. There, if the whole purpose of just keep raising in private market is to avoid regulation, then it becomes an issue.
Yeah, there are, no, you're right, I mean, this is a regulated space, right? And we have, like, I have to be very careful on what we do it the right way or we go to jail, right? We are an ERA with the SEC, which is the same designation as AngelList, right? And in the future, we may be a broker dealer, an ATS, or an RIA. We'll see sort of what route we end up going. But it's a regulated space. And there are some natural limits to how long Databricks or these companies can stay private. So for example, there is a shareholder limit, right? Private companies, excluding employees, can't have more than 2,000 shareholders on the cap table, right? So once they start to like get beyond that, they don't have a choice. They kind of have to think about like we gotta go public, right? Other reasons as well, but yes, regulated space, you gotta do things the right way. Takes a lot longer, it's a lot more expensive. I spend a certain percentage of my time just talking to lawyers. But it is what it is. I would rather do, it's better to do this by the book because these are securities. Right?
Fantastic. So, thank you first of all for walking us through that. Like a few more things. I know that like you previously created an offer for Xooglers. Is that still live so that some people can take advantage of it?
Yeah. So I remember, our pricing model is really cool. Like you have no fee, no carry, no transaction fee, no SPV fee, right? So like all 4 numbers are 0. You typically see in private markets, so 0% management fee, 0% carry, 0% transaction fee, and $0 SPV fee. fees. The way we make money is just a simple SaaS pricing model. So you pay $149 a month, and for purchase access to all these things, right? No other expenses. And we did have the code, so you can use the code STKS, and it will give you a special Xoogler price of $99.
Awesome, thank you for that. I do have a few more questions for Ali, but we'll be very happy to take questions from anyone who wants to raise their hand and ask Chris if you can assist me. Any questions for Ali now? Awesome. So I'll continue. Can you walk us through one or two deals that you personally invested in? You talked about Airbnb, maybe the background story and how you found that, I can actually invest in secondaries, and how did you ultimately end up having the conviction to invest a large chunk of capital?
I just liked it. So I kind of like investing in products that I know or use personally. It's sort of a filter. And so Airbnb was sort of planning to go public, and I found an allocation through a platform similar to ours, other competitors, I guess, called Forge. And Forge is now a publicly listed company as well. So I purchased an allocation through there, and it worked out. Some of the other deals like I'm excited about, I've done personally, are Mercury, the bank, right? So purchased a secondary position there because we're customers of Mercury. All my friends are customers of Mercury. The UX and the experience is like light years ahead of any other bank I've seen. Maybe there's something I haven't seen. And they're so fast to roll out products. So when SVB collapsed, right, they were rolling out FDIC sweeps within a week or a few days, right? So you could have your business cash automatically deployed across 20 banks, and your insurance limit would go from $250K to 5 million or 10 million, right? And you didn't have to do anything. Incredible execution, great founder. Some of the other names I'm excited about, I think obviously some of the blue chips like SpaceX and Stripe are exciting. Only question is price, right? As long as you get it at a fair price, those are fundamentally great companies. I like Vercel on developer tooling. A lot of folks are using sort of serverless.
Yeah.
LogRocket. I'm trying to find allocations into some of these names yet. Haven't yet, but Customer IO, some of these tools. So generally, that's my filter. For things that those have tended to be the best investments.
Got it. Do you think the time right now is more apt for making private secondary investment because of where the markets are? The interest rates are high, the war in Ukraine, the supply chains are still kind of not restored fully between the US and China. There's still a backlog of ships in the LA port and Oakland port, we see it. Then I think there's no recession, but there isn't any imminent signs that we're gonna go on a massive upswing either. So is this a good time, because all of these companies are likely gonna queue for IPOs as the economy starts to become better, and they have a short window of opportunity for cash flow or whatever reasons that they need to take some liquidity from private markets?
Yeah, so much of investing, private markets or VC investing, whether it's early or late stage, is about vintage, right? And I think 2023, 2024 are going to be some of the best vintages in a generation. Precisely because everyone is scared. There's 7% interest rates and all these crazy things happening in the world, and people are just not investing, right? Unless you're AI or YC or Xoogler, nobody wants to give you money, right? And that's even more true in the growth stages, right? The institutional rounds are even more frozen. You can still raise a pre-seed or a seed. The institutional rounds, A, B, C, D, are just, they get progressively harder.
Yeah.
So it's a permafrost in terms of fundraising, which makes it Takes a lot of courage, you feel like throwing up, but that's what makes it a good time to invest, and I think these vintages will be good. Certainly better than the last sort of 3 years where there was a lot of froth in the market, a lot of valuations. And they've come down dramatically, right? So blue chips, like Stripe, they did a tender about 18 months ago at a 95 billion valuation. Some of their secondaries were trading at 110, 120, 140 even at billion. And the most recent tender that did was at 50 billion, right? So that is at least a 50% markdown in valuation officially from Stripe. Some of the other late stage deals have cut their valuations 70, 80%. Stripe is sort of more of a blue chip, right? And I think the market is self-corrected. A lot of the froth has gone out of the market. So for people buying in now, right, it's a much better time to buy in at those prices versus late, because the biggest risk with late stage investing is actually price. It's not product market fit. It's not, is this a real business? Is this gonna grow? Yes, it will grow. It's a real business, right? Like the top 25, 50 names are fine. The biggest question is price.
Price. Go for it. We have a question.
Sure. Hi, this is Steve Kleeb, former Googler. So my curiosity is about this whole SPAC phenomenon, which seems to be dead now, but just get your perspective on, whether it's going to rise from the ashes, or is that pretty much, dead now? And oh, by the way, I worked at Stripe for 18 months. So every time you mention Stripe, it tears at my heart a little bit.
Thanks, Steve. And sorry I mentioned Stripe probably like 20 times. SPACs were sort of an interesting shortcut to kind of solve all of the issues where people weren't going public, right? What ended up happening was adverse selection, right? The companies that couldn't go public through the traditional channels, right, couldn't go and pitch institutions and endowments and pension funds to buy a piece of their IPOs, were then doing this SPAC route. And adverse selection meant these were, worse, sort of companies that were worse off, that couldn't go the standard route. And so a lot of them have done poorly. There's not a lot of investor appetite to investing in SPACs. Just look at Shaman's track record, right? It's a joke. And so I don't expect it to come back in the near future. It could. I mean, there certainly are one-off examples here and there, but yeah. But it is, as a mechanism, I think, like it was trying to solve a problem of like the bar was too high for companies to go public, and this was like a way to circumvent it. But just because of the performance, I think a lot of the best names in private are probably not going to do that. Some of the less lower quality names might, but I don't see any of the top 20, top 25 kind of doing that as a route to going public.
Thank you.
Brilliant. Ali, there's one thing I really admire about you is this ability to stay calm. And I think even though you say that you're not a good investor, that's one of the most important traits. There's so much volatility all around us. Even as an entrepreneur, you said that you pivoted multiple times, and then you have this uncanny ability to spot trends, like saying that what my customers are doing, they're not investing in early stage startups, even though they're angel investors, they're asking me for allocation in late stage. How do you build that skills over time? Like, can you start walking through, like, maybe your first few startups where you pivoted multiple times, and how do you spot these trends? That's a very important learning for all of us as investors.
Good question. I mean, thank you. I think you're too kind, as you are to everyone, Kushagra. I don't know. It will take a few years to find out if I'm really good at it, because venture investing just takes so long. For my first few startups, I think it was, I made a lot of mistakes, right? Shiny object syndrome. There's always something, the grass is greener on the other side. And a lot of the pivots we did were like jumping across entire industries, right? Oh, like cool idea, this didn't work, okay, like totally different idea in a different industry, right? So like Streamlabs, to give you a sense of like the pivots, luxury car rental, largest LinkedIn developer on the LinkedIn platform at one point, couple million in revenue before LinkedIn shut the platform down. Email sales productivity tools, employee performance management, HR tooling, 2 dating websites, a simulated crypto exchange that wasn't quite crypto, but it was sort of a pilot experiment. A daily fantasy sports betting website for esports, an esports team in there, the League of Legends esports team. We were number 2 in North America, called Vulcan, and then first season of LCS. And then all the players got hot groupie girlfriends, and their performance tanked. So these are like all of the pivots,
So was that your startup, or are you talking about a YC batch?
No, that was I was a team owner.
So one startup.
All inside one startup,
Wow.
right? 9 years, and the first 4.5 years were just spent in purgatory, wandering, right, from one thing to the next. So a little bit of shiny object syndrome. But I think what I learned was sometimes you can't just listen to your head. You need to listen to your heart. The best ideas are ideas that even if you forget about them, they come back, tug at your heartstrings months later or years later. That was the case with esports, right? So like we put this team together, it was worth nothing the first couple of years, and then a top 3. So I sold it, and I was like, this is like a team. There's no software here. There's no tooling. There's nothing venture scale about this. But it was exciting. We all watched it. We loved it. There's a lot of passion and there as a fan and as a gamer. So I got out of the space, even though my heart was like, this is exciting, this is like a new category, and this is 2013, right, early on, Cloud9 and like all of these big franchises, like Cloud9 started the same year as us, right?
Wow.
I know Jack, we were in the same season of LCS together. Cloud9 finished first, Vulcan finished second, right? So he kept at it. I listened to too many smart people and sort of got out and did other dumb shit. And those teams, like 12 months later or 24 months later, were worth, like a top 3 team was like worth 200 million a year later or 2 years later, right? So sort of hard overhead, kind of a mix of two. And yeah, it's
That's very impressive.
Anyway, we went through pivots. I think not giving up is like a big part of it, right? You get punched a million times and not giving up, and just understanding that this is going to take a few shots on goal. Another crazy story is we did a daily fantasy, sort of like a clone of DraftKings and FanDuel for esports, right? Again, same space, esports gamer, right? So, and we got up to $1 million in revenue really quickly. Raised a Series A with Sequoia, leading, right? Raised 16 million. This is 2015. 6 months later, some dumb shit happens in the industry. FanDuel employees and DraftKings employees are basically insider trading on each other's websites, right? They were like colluding, and so this giant scandal happens. Nothing to do with us, but it kind of blows up into this big thing where Congress and like regulators like just shut down the industry. Payment processors just shut off daily fantasy football and all of these fantasy sports. And so we were like, oh shit. And so 6 months later, like revenue goes from $1 million to 0. And we had just raised an A, right? And so we're back to square one. And we ended up getting into streaming tools and sort of in adjacent space, right? It was early days of Twitch. Twitch was blowing up, so it was a good place to be. And we ended up building a significant business in that space, doing content creator tools for Twitch streamers and YouTube live streamers, which Logitech eventually bought. But yeah, the 9-year journey was 4.5 years of purgatory and then 4.5 years of like the thing actually working.
That's crazy. For those of you who are not gamers, like Immortals, TSM, Cloud9 are basically Golden State Warriors, Los Angeles Lakers of gaming. A really powerful team. I'm a fan, so yeah. Chris.
So Rajiv, do you want to unmute yourself and ask your question, or should I ask on your behalf? Maybe for some time's sake, I'll ask on it.
Me a while to unmute. I'm in a car right now, that's why. Apologies for that. So I was wondering, if you could elaborate on the difference between primary and secondary deals and the difference in investor mindset needed for that. And of course, primary deals is harder to get access to right now today. But there are funds like Partners Group that allow certain classes of investors who have access to them that are not, multi-million-dollar VC type people. And so I was wondering, you probably know about those. I was wondering, what do you think about them, and how should investors who are able to dip into both do both, something like Partners Group, private equity, and your platform for secondary, maybe smaller secondary, access to secondary deals as well. So that was my question.
Yeah, that's a good question, Radeep. Thank you, Radeep. I'm not familiar with that specific fund, but there are, the way I think about secondaries is it's like a gap in your portfolio, right? You have public equities, you have real estate, maybe some crypto, and you have some early stage investing you're doing, right? The early stage stuff is going to take 10, 12, 14 years to mature and actually return money in most cases, right? That's the typical sort of venture life cycle if you invest in pre-seed or seed. And late stage investing fills a gap in that portfolio where you can still capture some of the alpha in private markets with a much shorter time frame to liquidity, like a 2 to 4 years. So the expectations for investors, I think, if you're investing pre-seed or seed, you're looking for ideas that can 100x that, and you're really betting on people a lot more, people and markets, more than like whatever product exists there, because, most teams pivot, they change, they learn, and they course correct as they grow. So it's really a bet on people and 10-year holding periods. Late stage, it's a bet on sort of product and market, as much as a bet on the people, and price is a lot more important, right? Late stage. So like early stage, whether you invest at a 10 or a 20 pre, right, is less important. Late stage, whether you pay $22 per strike or 44 is like literally make or break, right? So that's how I would think about it, and I would think about sort of a whole portfolio. Diversification is important. You don't want to go like YOLO all in on one deal. Those make for good stories, but they make for generally people losing their money, right? So you wanna stay rich and get richer rather than sort of YOLO on so diversification, invest into several deals. Early stage, my sort of benchmark is like you want to do like 100 deals plus to get consistent returns. Late stage, you probably want to do at least 10.
For Kevin, YOLO from his bonus in his 401k. Did the trick for him though. So for every piece of best practices, it can also work the other way. Teresa, why don't you unmute and ask a question?
Hi, thank you, Kush and Ali. I just had a quick question about, I'm looking at the app, and it looks amazing. It has all the stocks there in the private portfolio, and I was curious, because, and sorry if you answered this, as an investor, if I invest, do I choose a stock or a group of stocks, or their portfolios already put together that I'm buying into a portfolio of all the equities that are already kind of pre-set up?
You choose an individual stock or company, right? So you would pick a Databricks or an Antivirus or an Epic Games or Notion. We're planning to do an auction with Notion soon. Replaying Epic Games and Flexport are coming. So yeah, it is very much like Robinhood, where like you pick your own stocks and build your own portfolio. we do recommend people to still diversify and build a portfolio, several deals rather than one. But yeah, you pick.
Okay, that's cool. I will mention I worked at Databricks for about 3.5 years, so I'm glad you're talking about Databricks, because when I started at Databricks, nobody heard of Databricks. Now I think they're in the news, all the time.
Yeah, an excellent company.
Yeah, and you still have your shares?
I do.
Oh, good for you. Good for you, the way to go. Maybe we should be talking to this group about selling positions
Yes,
rather
exactly.
than investing.
So you can enable liquidity with the research now.
Yeah, I mean,
Yeah,
guys,
sure.
if anyone wants to sell their position, feel free to reach out. Ali at Sandhill Markets.
So Fabio
Okay.
was asking about the code. So Fabio, we'll send an email with the code and a link to get on Sandhill Markets, and with a personal letter from Ali as well.
But I think it was STMKS.
STKS.
STKS.
STKS. So Drew, you want to unmute and ask your question?
Sure. Thanks, Ali, for coming. I have a few. I'll just start with the first couple. So in terms of how you first got into angel investing, I know you're a serial entrepreneur. Was that mostly just through your network you'd established through that, / do you have any advice for folks looking to get into earlier rounds these days to help get access to those opportunities? Because I understand your platform is more on the later stage side of things. And then also a second question in terms of how you get the shares listed. Are you having to basically get approvals individually from each company that you're representing, or are you getting allocated a certain percentage of each equity round?
Question.
Yeah, good questions. The first question, I think it's much easier now to sort of learn and get exposure in ways that weren't possible 5 or 10 years ago, right? So one thing I'd recommend is join some good syndicates on AngelList, right? Join the Xoogler syndicate. I know Xoogler and Chris have been really active early stage, right? So join like 5 or 10 of them, and they'll send you deal flow, and you will develop a sense of like, okay, like what kind of deals are there, what's baseline, and what is good versus bad, and what prices should I be paying, and you can do all this without writing a single check, right? So it's a great way. Attend demo days, right? Wherever you can. That's another way to get sort of exposure and deal flow. YC 500, Techstars, there's a bunch of South Park Commons, StarDex at Stanford, Berkeley Skydeck. There's a bunch of like incubators, especially in the Bay Area. For Xooglers and people located physically in the Bay Area or New York, like you will have access to a lot of personal networks and deal flow as well. So more the better. And second question, how do we structure these deals? Do we get company approvals? What do they look like? So typically we will be a small piece of a larger transaction, right? So whether it's like a fund selling like a $25-50 million block, or like a new equity round that's happening, which is a tender, we're going to be a small piece of that. And so whoever is the lead running that process will get company approval, and we're going to set up a small SPV to take a small bite-sized allocation of that round. Down the road, if we're like 10 times bigger than we are today, yes, we may be leading some of these rounds, we would be interfacing with some of these companies directly, but right now we're too small to kind of interface with the companies. And so we typically rely on other investors who are leading these things, who let us into their rounds. Structure is usually an SPV, right? A special purpose vehicle. It's just basically a single investment fund, pretty standard. That's what AngelList, Garda, all these guys use. You own a piece of the SPV, which owns a certain amount of shares of any one of these companies, right? So say an SPV owns 10,000 shares of Anturo or Databricks or Epic Games, and you buy 1% of this SPV, that gives you exposure to 100 shares.
Awesome, super helpful. Thanks, Ali.
Yep.
Awesome. Awesome. Are there any other questions? Oh, Ajay.
So I know this is discussions based on personal finance, but from your founder experience, I guess, what was it like having to stay motivated and kind of raise money through all these pivots you went through, and convince like investors, employees, things like that, that like the new direction that you're taking is the right one for the company?
There's no easy answer. I mean, it's really tough. The toughest part is it's really tough on people. Very tough because you've first you've sold yourself on like a direction, a vision, idea, then you've sold all the people who you've hired and they've bought into that, they're excited by the direction, that's why they joined the company, and then when things change, like a lot of people can't change. And so we ended up, with my last startup, we did 2 layoffs, like we got up to 70 people, 100 people twice, and we do 2 layoffs down to 15. And I think some people just couldn't take so it takes people do have to develop a thick skin and have a lot of grit. I had an engineer who developed a drinking problem, right? He was just he went down like a dark rabbit hole, just drank a lot, stopped showing up to work. Eventually I had to fire him because this was the first layoff, he had experience and he wasn't laid off. But even though he was still at the company and a job, he got a raise, emotionally just he was a wreck, right? So it's really tough, and I think personally as founders, having a co-founder makes a huge difference, right? Doing it alone is much harder. Having a co-founder who can be a good emotional partner, having a spouse or a life partner who can also be supportive during this period, meditate, exercise, take long walks. Sometimes I think just Netflix and games, right? I don't do drugs, but some people, you can go to what is that? It's any other parks in San Francisco. That's what people are doing all the time.
Don't do that.
Don't do that.
Don't do that. But awesome. I think we are at time, Chris. So I want to thank you everyone for joining. We're going to do this again. And first of all, Ali, you are not only an incredible entrepreneur and an incredible supporter, most importantly, you're one of the nicest people I know. So thank you again for coming today. Hopefully this was helpful to you as well. And we'll capture some feedback and share the links with Xooglers, and hope to see you soon again. Thank you.
Yeah, no,
And thank you everyone for attending. We'll share more information about the next week's session soon. Cheers. Have a good evening, everyone.
Thank you.